The break-even stage in trading, where you feel like you've been putting a lot of effort into your trading to make it work, to make it profitable, but you're not profitable yet. How to get out of it? Now, the good thing about the break-even phase is that you're not losing money, but we gotta find a way to get out of it and focus on becoming profitable instead. That's what we'll cover in this video today. What's up, traders? Welcome back to Thailand once again. I'm in Pattaya right now, near the beach. It's a pretty good place. Now today I want to give you some tips on how to get over the break-even stage in trading. So you've been trading for a long time, you're not losing money so much, maybe losing a little bit of money, but you're not profitable either, and you cannot be consistent. And a lot of your goals, a lot of the things you want to achieve require to be profitable first, and then consistent after. So how to get out of it, how to solve this, we'll discuss this today in the video for sure. Now, I want to give you 3 tips and 3 ways to be able to get over that phase. If you stay until the end, I'll give you a bonus where you can do this, a bonus tip that really helped me a lot. But let's focus on these 3 ways that really work and will help you get over that break-even phase in trading. Okay, so the first thing is understanding your mistakes. Now, mistakes are something that people think they don't make in trading. They think that for some reason other people make mistakes more than them, but they do a lot of mistakes themselves. And we just sometimes don't spot them, or we spot them in the moment, but we forget about them after. So the key here is to be able to understand your mistake, keeping track of them, because most of the time you'll make the same few mistakes all the time. It's going to be like not 1,000 mistakes, but 1, 2, or 3 mistakes that you keep repeating that is preventing you from being profitable in trading and getting the results you want later. And that's a big issue, of course. So if you want to keep a journal with your mistakes, what I do is I simply use a website called Trello, and I basically enter my trades there. And from there, I'm able to see each trade I take whenever I make mistakes. I write down which mistakes I made and how to solve it. Now, that's something that can make a big difference on your results overall. And eventually, we cannot get to a point where we make no mistakes in trading. We'll always make mistakes sometimes. I still make mistakes today sometimes, but we need to be able to spot them and reduce them in the future. That's the key. Now, a second thing that really helped me a lot when I was in break-even stage and also losing money a little bit was to improve my trade management. And you can do this, in my opinion, in 3 ways. Now, there are many ways to do it, but my 3 preferred ways are: 1, using a T1, T2 approach where you have 2 take profits and you're able to have a take profit that's further in the market. So let's say it's 3 to 1 or 2 to 1 reward to risk. Even if you want to do 4 to 1, 5 to 1, that works fine too. So you have a take profit that's more far for half of your trade, and then one that's closer to your entry for the other half of your trade. So that if price goes in your favor a little bit, you try to lock in that profit. You have this first trade that you go out of, but then you have this second trade that you stay in longer for big moves. Now, often people have a fixed take profit like a 1 to 1, 2 to 1, or so on, but they're not recapitalizing on when the market moves big. Now, sometimes the market won't move at all. It's just going to move a little bit, get you that first take profit, and then reverse back against you. And that's fine. That's why we take that first take profit, is to secure the trade. And the other one is there for like bonus, right, for plus. If you want to move your stop loss to break even once you have reached the first take profit, you can do that for sure, but you don't have to. Okay, that depends on, of course, your personality, what you prefer, and how your strategy works, of course, in the market. The key is having 2 take profits so that you're able to lock in profits first and get safe on that trade and reduce your drawdowns by a lot. And the second take profit is a bonus that you can add to it. So if a big move happens, instead of having a small profit on your trade like usual, you have the small profit plus the big profit, which will make a big difference. Now, the second thing that you can also combine to this is being able to get out when the market starts to reverse. You cannot just kind of like decide where you want to go out and go out. That's really difficult. You got to know price action. You got to know when the market is likely to reverse, what signs are in the market that predict the reversal. And if you can get out there, then you're probably going to save a lot of time. Often people are too late to get out and too early to come in the market. They enter trades so fast, they get into the market really quick because they want to be in the move. But when it's time to get out, they give it some time for the market to pull back, to see the market, because they think the market might go back in their favor. And that gives them a huge profit loss on that trade. So you want to be able to know when the market starts to reverse and get out right there. Now, you could use this with the T1, T2 approach. We have 2 take profit. One is the first one that you get out really quick to lock in your trade and at least get break even. And the other take profit, or even could be a trailing stop, where you're kind of trying to look at whenever you have a big bearish candlestick, let's say a big engulfing candle, then you get out of the trade. So you can combine these 2 things. You let price go in your favors for some time. When price starts to show closes below the low of the previous candlesticks, then you're able to get out, and that can make a big difference. Now, the third way that you can manage the trades better is by reducing correlated trades. And that's a big mistake I see people make, is they have like 20 pairs they want to trade, or they want to trade all the Forex pairs, but they don't understand that most of the pairs are correlated. They move in the same fashion, they have the same moves. And that's a big issue, because what if you enter 5 trades and all 5 go to be losers? Well, you could have entered only one trade, and that trade will be a loser. So it's like a 5% loss compared to a 1% loss. Which one do you prefer? I'll pick the 1% loss for sure. So you got to be aware of the correlations, what pairs move with each other. And a simple way to do this, of course, is looking at the currencies. So if you trade like Euro USD and USD CAD, these will be correlated because they both have the USD, the US dollar, into them. If you trade the USD JPY and the Euro JPY, these are correlated. They have both the Japanese yen in them. So be careful about this. And same thing goes with indices. They can be correlated or negatively correlated. And that's something you gotta be aware of. Now, I won't discuss this too much in detail here because you can have a look at this on your own. You can find out what's correlated. If you go on TradingView or any kind of charting software, you can sometimes add 2 charts, like 2 pairs at the same time, and you'll see how they are correlated or not correlated, these pairs. And that's something that will reduce for sure your drawdowns if you're trading trades now that are correlated. Now, the third aspect before my bonus tip for getting over that break-even stage in trading is to filter the market phase. Now, I see a lot of people who are entering trades whenever they have a setup. They look at this indicator, that thing, price action in this, and then they enter the market right away. But they never look at the big picture view of the market. They never look at the market phase that I call. So how the market's behaving on a bigger time frame. Is it on a trend? Is it sideways? How big of a trend? Is it a strong trend, a medium trend, a really weak trend? And what's likely to happen in the market? Now, this thing on a bigger time frame makes a big difference even in lower time frames. You'll be surprised how if you filter by this bigger time frame trend or market phase, you'll have a much better result on the lower time frame. It's for sure not a perfect science. It's definitely better to get in the trade and have more confidence in that trade overall. Now, this also means the fact that if, let's say you trade, for me, I trade support in resistance areas. If you trade a level, a support, let's say for example, and you enter a trade and then the trade works against you, you hit your stop loss. When the setup reappears again, if you cannot stay later, do you want to re-enter again? Now you could, but I prefer not to. I prefer to re-enter maybe 1 time, but then after 2 times it's like counterproductive. I re-enter too many times, it's getting me too many losses, and I end up like having 5 losses at the same level. Now, why would you do that? Why would you have 5 losses at the same level if you could have only 1? And that's why you want to reduce the number of trades you take at the same levels. If you have levels in the market that don't work, stop trading them. Don't put in more trades. Don't put in more orders at every setup you have. It's a waste of time and a waste of your energy as well and capital. So you want to be able to know how many re-entries you can have at a specific level or for a specific trade that is likely to work out, but it's not too late where you have too many losses and where just this one win kind of only recovers the losses you had before. So you want to be able to trade a few times, but not too many times. So that's a big difference. Okay, I promised you a bonus tip here in the video, and that bonus tip is something that really helps me a lot. And it might not be obvious, but I think it's gonna make a big difference once you really understand it yourself. And that is to test everything. Now, you'd be surprised how most people don't test. They have this idea that they find online on Google, then they implement it, they trade it right away in the market. Like they go from Google to trading live, like super fast. Same thing with YouTube. And that's not going to work out because the fact that you never tested for yourself, you've not seen if that's still up to date, the strategy or not, and you want to be able to know how it's going to perform over time, what the stats will be of this strategy. And that's why you want to do some testing. Now, here's something you can test. Test your entry, test different indicator, test different market phases. Is it better working in trends or counter trend? Sometimes strategies like mine work better in counter trend. If you trade them with the trend, you'll get stepped out all the time. And that's weird, but that's how it works. Now, what time frame is it working better on? What pairs is it working better on? Are there some pairs that are losing money that you are trading them because you think they're good, but in the end they're just losing you money over time? Now, as soon as you reduce these things, you focus on what works and cut out what doesn't, you'll be able to get out of that break-even phase. Hope you liked the video. Here are some other videos you can watch after about how to be able to get profitable, get better results in trading. Subscribe by clicking here if it's not done yet, and I'll catch you back here in the next video pretty soon.